Hey, good morning, everyone. Good Monday morning. Thank you for joining us again. Um, this is our regular Ask an Economist. Hopefully, we'll get some great insights from Dr. Eiler this morning. Any questions that you have throughout the presentation, go ahead and put them in the chat feature, and Dr. Eiler will do his best to reply to them all at the end of this presentation. And also, recording would be available uh, on our website, thechavinconcepts.com, after the fact. So, Dr. Eiler, it's all yours.
Thank you, Vicki. Folks, thank you so much for coming this morning. I want to start us with the American labor market situation. The American labor market is in growth mode still. We're going to find out more on Friday. But what I want to show you just as a comparison, this is the evolution of the American labor market from November 2007 forward to where we recovered the jobs lost in the Great Recession. We started November 2007. We end about 78 months later. And this is what's happened since the pandemic in comparison. We're about 4.9% above where we were right as the pandemic began in January 2020 in terms of seizing up labor markets. And as long as this black line continues to move forward and not toward the red dotted line, we will continue to not have a recession in the United States. So some of the things I'll talk about in a minute with respect to tariffs and some of the issues going on from a policy standpoint, we should be able to avoid recession if we have a little bit more clarity in terms of the certainty of policy. Now, the next step is prices, and there's been a lot of chatter about what the Federal Reserve is going to do now that we have some uncertain policies that might elevate inflation. These data are what we call core personal consumption expenditures prices, which are basically the percentage change from 1 year ago in what it costs us to buy everything we buy at home, less food and energy. That's what makes it core. These data are monthly, seasonally adjusted from January 2007 forward to February. The March data come out on Wednesday. And the point here is that the blue solid line is the evolution of those data in a raw way. The blue dotted line is where the Federal Reserve kind of wants to drift the blue solid line over time and have it weave around like a wave if it can. The red dots, which I'm now going to highlight, show the forecast as of February for these data through the end of 2027. So the Federal Reserve is very concerned about recent policy actually elevating these data, and kind of the things to consider are, will the shocks that have sort of hit the American economy, specifically tariffs and the threat or the reality of deportations, change things like goods market prices, wages, the price of inputs in such a way that we will not be able to relieve the inflation we saw coming out of the pandemic? And you can see we had very slow, steady inflation from 2007 to about mid-2021. We saw this very big spike in prices, and we've been drifting down ever since, paying for it with relatively high interest rates. So the game in town is what the Federal Reserve is going to do. They meet again the second week of May. We're watching the data very closely in terms of what's happening with prices. Now, if the bigger stomach churning piece is what's happening in your portfolio, I want to show you this in kind of a long view. If you look at the American economy from, let's say, 2000 forward, we've seen an amazing bull market, especially coming out of the Great Recession, which is that second shaded area moving left to right. We see this bull market. You see some hiccups, even around the pandemic, which is the third shaded area moving left to right. Not much change in the long view. And so one of the things about what's happened in our equity markets over the let's say the last 6 weeks is that, yes, it's been a real nasty downturn. You can see that on the far right. This second line is the 6-month moving average of the S&P 500 over that same time period from January 2000 to just 3 days ago. And then you're going to see in that far right-hand side kind of the shock that we've been on. But I wanted to give this long view because it is intelligent to think about not just the last few weeks, even though that will give you a stomach ache. It is really thinking about the longer view and where investors are. And you should really think of the S&P 500 or any equity market index as a measure of investor certainty or uncertainty. And that's what's really going on right now, is we just don't know what's going to happen, and also taking some profits off the table after a really long stretch of growth. So we're watching this closely, not so much because it's the only forecasting tool. It's part of the forecaster's toolbox, but we have to watch closely to see what it means in the end for policy. Now, these data I'm going to kind of move through quickly. This is a forecast that the Philadelphia Federal Reserve does, and these came out in February, which seems like eons ago now, given all the zaniness at the federal level. But for real GDP growth or income after inflation, for the next few years, these forecasters, there's 40 of them that the Philadelphia Federal Reserve interviews every quarter, saw actually a little bit more optimism from their previous quarter's forecast using the quarter 3 data. The latest forecast that's in the box there is from quarter 4 and then ultimately realized in February 2025. We think there was actually more optimism for the next couple of years and then a little more pessimism for 2027. And a lot of that was born on the idea we're likely not to see much change in the labor market. And that's the unemployment rate over the next few years. You can see those numbers are barely changing and really not much change from the previous quarter and really not much change from very, very strong numbers. And there's those core PCE inflation data again. And we look at all this is actually a pretty decent forecast. Now, the trick is because we've seen so much policy uncertainty in the last, let's say, 8 weeks, and you can even say since late January, we've seen a pickup in the probability of recession, but not necessarily a declaration that one is going to happen in either 2025 or 2026. However, we're watching closely to see what happens with inflation and how labor markets start to react. And as I said right off the top, if those labor data do not start to move back toward the red dotted line in that first graph, and really to think of that we see a downturn and more people losing their job and really more labor market uncertainty, we won't have a declared recession. It just might be a continued uncertain, slow slog for at least the next 18 months. We will see what happens in terms of policy reformation. Now, with that said, there are some high frequency forecasts that we're watching closely. So these two come from the New York Fed, which is the blue line, and the Atlanta Fed, which is the orange line. And they use, in essence, the same macroeconomic theory and basically the same modeling. But notice there's been a strong deviation about the first quarter of 2025 since, let's say, early February. Now, in early February, we started to see some of these changes get realized in terms of policy. We saw Western Europe tariffs threatened. We saw copper tariffs threatened, which copper has a wild, deep effect on our lives, at least from an economic standpoint, is if you use any kind of electronics or any kind of cabling, copper's there. The main trading partners of the U.S. had their tariffs increased in March, and then on April 2nd, we saw the sandwich board come out with every single country on planet Earth, and even a few that don't really exist, suggest that we had generalized tariffs. So that started to freak out forecasters, at least in Atlanta. But you see the New York Fed forecasting unit has really not changed its stance. So we're in this really weird time where the timing of how policy changes are going to affect the American market is still somewhat at question. So watch this as it evolves. We are going to get the first slog of data for the first quarter on Wednesday as well. So watch for that on April 30. April 30 is a big macro day in terms of the data in the United States. Now, if we move to California, the evolution of the California labor market looks like this. This blue line is the labor force on a seasonally adjusted basis from January 10 to just last month. We have recovered the number of people that are working, actively seeking work, or have a job with themselves, sorry, they're self-employed, since the pandemic, but we have not recovered the number of Californians that have a job and of that blue line or work for themselves. That still has been very, very flat over the last 28 months after we saw pretty decent recovery getting toward the pre-pandemic benchmark. This black line is the number of people who work for a California-based employer, including self-employed folks that live in California. And that is closely mirrored what's happened with Californians working. The key, though, is that both of those have flattened out. So in California, we're seeing a little bit more sluggishness in our economy than the US. And we're watching closely how much more California might be threatened either by direct or indirect policy movements at the federal level. Now, if you look at the MSA level, this is what's happened at the MSA level, at least through the end of 2024, looking back 1 year. So growth pretty much across the board for most of our metro areas. You can see Shasta County and Butte County are called out there with both about 1,500 more people working in those two counties. Sacramento, about 17,000. Riverside continues to just burgeon alongside of San Bernardino County, really leading the pack since the pandemic in terms of jobs growth. Los Angeles had a really great year in 2024. San Francisco and San Mateo County on the far right-hand side kind of had a little slower time. But the reason I show you in this ordering is the next graph. If we think about what's happened since January 2020, you can see on the left-hand side, Sacramento and Placer County specifically, kind of thinking about that MSA that includes Yolo and El Dorado County as well. And then Riverside and San Bernardino County have seen the best outcomes in terms of the post-pandemic world and creating jobs. But Los Angeles and San Francisco and San Mateo counties have been the slowest growers. And that's why California still has not recovered, is because those two counties chew up an enormous amount of our labor force, and also kind of concentric support are in those regions around those two counties. We're waiting for that recovery. So for California, we're going to see the governor's revised budget the second week of May. We're hoping that we're actually have pretty good news. These data and the forecast looking forward suggests that actually things are looking better, especially if you look at last year, but we still need to get past the original pre-pandemic numbers. This is the labor force in California. This is the number of people working. There's people working for a California-based employer. Looking through the data annualized, we saw just before, but then that shaded green area is the forecast that the California Department of Finance is using to look forward to support the governor's budget. So actually relatively optimistic inside that green shaded area. The problem is that we did not expect as much policy uncertainty coming into the Trump administration, even though this forecast was put together after the Trump election. We will see, in fact, if the May revise reflects that change, plus the equity market data we saw before. And the other reason I show you the S&P is because we want to make certain that we don't have, let's say, our eyes not on the idea that our tax code still very much depends on personal income driven by jobs growth, and then ultimately equity market growth driven by what happens in the S&P 500 as one way of gauging that change. So these are optimistic. We will see how much that changes in a little while. On the housing side, we've seen a little bit more pessimism in both, and generally with housing forecasters. In the latest forecast coming out of Zillow's economics group, they're suggesting that basically every single county or area in California is going to see downward pressure on housing prices. This is a forecast through the first quarter of 2026. And you can kind of see that on the far right-hand side, we're seeing a lot of Northern California, including very Northern California counties. Not all the counties are represented on this graph. The rest of them are between Monterey and San Francisco counties. All negative. Two major ideas is one, equity market sell-offs do not necessarily help housing markets in the short term. Everybody kind of retrenches simultaneously when there's equity market downturns. And the second is with the policy uncertainty and an unknown outcome in labor markets, the supposition is that supply might be a little larger than demand across most of California. You can see California on the far left-hand side on average is about 2.1% down. Now, in terms of housing, we have seen extraordinary growth over the last few years. So if we got to give back 2 or 3%, we shouldn't be troubled by that too much for 1 year. The key is whether or not we're actually going to start to see trended downward movements, or if a labor market shock takes place, what's that mean? So when we add it all up, if you think about what's happening, our sort of news and our economic thoughts are really dominated by, okay, what's going to happen to the cost of doing business, the cost of labor, the cost of living because of tariffs? Folks, tariffs, again, are an indirect sales tax. If I didn't say that before, and make sure it's super clear, do not expect consumer prices to be unaffected by what's happening with tariffs. The key to tariffs is whether or not they last, and in what ways do they really accelerate beyond expectations, or in ways that start to permeate numerous supply chains. We're going to watch that closely. And related to that, as I suggested before, is the Federal Reserve now going to pivot and not necessarily keep pushing rates down at the same pace, but actually not going to do it more slowly, or potentially just hold because they don't know whether or not inflation is going to go up. And if it does, they do not want to exacerbate that pressure. In California, we're going to watch what happens as time evolves. We're hearing a lot more now about deportations. Last 5 or 6 weeks have been mainly tariffs. We're starting to swing a little bit more toward the next round of policy. And if you think that the Trump administration looks like that they don't have a plan, do not be fooled. There is a plan, and there's almost like a football-related 15-play scripted start to the administration that seems to be playing out pretty much close to the script. And the idea is that they really wanted to put the international pressure on, and then they want to look at the domestic market. And that seems to be happening. The key is what that means for California's economy and ultimately the state budget, especially if you're a state worker or you're a community college professional, CSU or UC campus administrator or professor or staff or researcher. The pressure is coming from a lot of different vectors. Our housing markets are fading a little faster in Northern California. I know a lot of us on this seminar are, in fact, from the northern part of our state. One of the things we're looking at on the coastal side is whether or not that cannabis is a driver in that. We think it is anecdotally. We really don't have data, unfortunately, to support that hypothesis. We're watching that closely to see if that market's further affected. In terms of things to watch what's happening with domestic and foreign issues in terms of, we also have this issue with the US dollar. Now, the cool thing is when the US dollar falls, that should, in theory, provide more market opportunities for agriculture, for manufactured goods coming out of the United States. But if there's current reduction of buying American goods is almost like a policy protest, the dollar's downward value might be exacerbated and not necessarily help in the short term rekindle exports. We're watching that closely. And as I said before, really watching those rates and inflation are going to be the big macro look. And ag in California is something to see whether or not China starts to change its stance toward California agriculture and what that means, a la what I just said. Are we seeing markets retrench in general because everybody's mad at the United States right now? Canada's election is today. We will see what that means in terms of their policy stance vis-a-vis the US. A lot of craziness to come. So, Vicky, with that, that's what I have for today. I want to thank Shaban for continuing to support this time with you all, and you all for making the time today. And then I guess now we'll open it up for questions.
Okay, thank you, Rob. Yeah,
Of
anybody
course.
who has questions, throw it in the chat. And actually, you have our email addresses. So if a question comes up a little bit later, you can always email us and we'll do our best to find a response for you. Oh, there's a question in the Q&A. Doug, is California's unemployment more affected by Newsom's policies than by Trump policies?
That's a really good question. I would say that California is probably going to be affected more by Trump than Newsom, in the sense that Newsom has a disincentive to reduce employment in California, and he probably will have to do things that would be maybe less politically fathomable, or you could say, consumable, versus what Trump is going to do, with the idea that has sort of parry whatever vector Trump pushes toward California. So I think that Newsom's going to be a little bit more jobs friendly for California than Trump will be. Some of that will depend on whether or not we have any kind of reversal in terms of climate change and move more toward fossil fuel, which is highly unlikely, and whether or not we see more deportation. So if deportations take place en masse and California feels those effects, it's going to get a little weird in the California labor market. It's really going to test the hypothesis of how much we depend on that sort of migrant workforce, or the undocumented workforce, with respect to filling jobs that other people in California will not want to do. And if there are large deportations, whether we see a labor force emerge to take the jobs that are left behind. So I think on net, Newsom will probably be net positive versus Trump.
Okay, thank you.
Uh-huh.
Another question from Mark. With CSU Chico looking to make some staff cuts, and as well as Congress's potential cuts to Medicaid and the federal reduction in force plans, what do you see as the local employment look in Chico, Butte, Shasta, kind of the North State?
It's Vicky, can you still hear me?
Yes, I can. Yeah.
I'm sorry. It's going to get a little weirder before it gets better, unfortunately. So one of the things that'll be intriguing to see is how much more pressure is put on soft dollars by the Trump administration that's coming from the federal government, how much that might affect student loans, student grants, the federal support for higher education students, and then ultimately how the California budgets issues start to affect sort of the core of state funding that would affect CSU Chico or Butte College, or any of the regional institutions of higher education that ultimately might affect people that live in Chico or in Butte County. But with CSU Chico being kind of the core, or a major employer and a major engine inside of Chico and in Butte County, there are more challenges to come in the short term, unfortunately, than will be resolved. So we've got, and this is true across the CSU system, unfortunately, Chico's just one of the sort of big five outliers, alongside of places like Sonoma State, where I teach, Humboldt, San Francisco State, that will face a little bit more challenges than, let's say, our Southern California cousins as we move forward. So Chico, unfortunately, is probably going to have a little bit more downward pressure than upward pressure in the short term. But the things that President Perez has put in to sort of turn the ship around are medium-term measures. He knows that the economics of the short term are going to be tough, but that the thing is going to create a better foundation, and he's very much focused on that, and he will be an amazing leader for that change over the next few years.
Okay, thanks. So with all of the energy, food, the housing costs, a lot of the looking forward and some of the economic stress that we're looking at, that and the fact that investors are kind of bailing on some consumer staples products. Do you see this as an indication of maybe a uh, deepening bifurcation from a socioeconomic standpoint?
Yes, and there are going to be questions of things like universal basic income coming back, especially if we start to see job loss that is sustained over time. That it's flabbergasting to me that we haven't thought more about our basic social supports in terms of these policies. But the supposition right now in the Trump administration, I think, is that there are more people who are undocumented and not citizens pulling off of that support mechanism than quote unquote citizens. So part of the game in town is to continue to pressure that to sort of force either more undocumented folks to come to the surface and thus be in the queue to be deported, uh, or leave on their own because the economic opportunities have left. It's a very sad state of affairs, unfortunately.
So with property values dropping, would you expect to see a pickup in housing sales?
That's a really good question. It's very intriguing to think about, and there's hundreds of thousands of pages written about what how let's say equity markets affect housing markets. So one of the things that we're watching closely is to see how many more houses start to go on market in metro areas or in at least in maybe suburban areas and rings around our major urban areas that look like people think like this the end has come and that they're going to make a final decision to either stay or go, even if there's no labor market shock. So the equity market change might say, okay, now I need liquidity, so I'm going to put my house up because we need more cash than we expected and we're creeping up on retirement, and now we're going to make a decision to leave. Or is it going to be, for example, that there is no labor market shock and the equity market downturn means that people have taken profits off the table and they now want to diversify their portfolio, and as housing prices slip a little bit, people will still have the cash to move into those now lower cost houses and take on that other asset. So there's a lot of fluidity, if you want to say it that way, in terms of the vectors that are affecting housing markets and what that might mean for housing markets going forward. And also, we should not get too caught up in the short term. A graph I did not show you today that I normally show, because I wanted to leave a little bit more time for questions, was the recent and like last year's gains and then the last 5-year gains. So Northern California prices have slipped, but it's really only Mendocino County of, let's say, the 25 to 28 counties that populate the area above I-80 or along I-80 that has seen negative growth since the pandemic. All the other counties still have growth. Even with this forecast, there'll still be positive gains in housing by next year. The problem is it's slipped in places like Butte County, Shasta, in Sonoma, Marin, Napa, that it's starting to get closer and closer to single digit growth rather than this wild double digit growth that we see specifically along the I-5 corridor, sort of south of Fresno. So it'll be intriguing to see how much of that people think about, well, if we made 25-30% in our home and we see people are starting to put their houses up, maybe we better get in while the getting is good, just like other equity market, and take our profits off the table. That might start to affect the amount of supply that's out there too. But boy, we got a lot of volatility coming up if we don't have more policy certainty in terms of threatening a labor market shock that will really change housing markets.
Okay. So what are your thoughts on the regional economic impact of some of the announcements of the Northern California refineries closing or moving out of state?
Yeah, I mean that I don't think it's going to really like have a large effect on general labor markets, but it'll be intriguing the upward pressure that puts on fuel prices and how that might indirectly start affecting jobs. So how much that change is, let's say, permanent or doesn't move to some other fuel sources, and how much we in California and then ultimately in Northern California really think about how we fuel our commercial and personal vehicles. It's that refineries should have more of an effect on the gas price than it will, let's say, on general labor markets. But that really depends on how supply chains are affected by the price of fuel rising regionally. And that's under the assumption that we won't have some other supply come online, or we won't have it change logistically in such a way that the price doesn't have to rise too quickly. But that's where I see more of the threat is on the indirect side, in the sense that refinery closes and it's the availability of fuel that then starts to change the cost throughout supply chains than necessarily in, let's say, concentric circles around the refineries.
And how significant has deportation been so far on the California ag and really on any other states, or do we just not have those numbers yet?
I don't think the numbers have really appeared. And the weird thing about undocumented workers, if you want to think of deportation activity as being focused on an undocumented population, um, where the agricultural community is very much up in arms, at least the ones I've talked to, about where they're going to find workers and what that might mean for yields, what it might mean generally in terms of economic value from agriculture in California and also other parts of the United States. You can see this where we have farmers who like the Trump policy and the Trump platform going into the election, but I think have been somewhat befuddled by how most of the policies that have been pursued by the Trump administration in the first 100 days have unfortunately had more of a lean on the cost toward agriculture, at least on the front end. Some of that is yet to play out, especially as we move toward the 2025 harvests and livestock sales. So we're going to see how much that starts to change the game for farmers in California. And the hope is that there is actually some relief for farmers, and that whatever deportation activity takes place in such a way that there's a better transition path in terms of how farmers are able to find other workers or to at least insulate that blow from farmers. But agriculture is going to face many challenges, unfortunately, over the next 18 months, probably through the mix of policies, at least in the current stance. But that could reverse itself next week for all we know. But we're going to watch closely, and ag is, for better or for worse, going to be on the front line of those initial effects by the nature of the mix of policies for the time being.
Okay. So this is a new one to me. I had not heard this, that Trump
Hmm.
now has an executive order establishing an Office of Shipbuilding. And kind of what are your thoughts on that, particularly shipbuilding in Solano?
Yeah, so shipbuilding in Solano, we might actually see a little bit more focus if that sticks. And maybe these sort of medium-sized ships are going to start coming back toward Vallejo. Chabin and my company just got done doing a medium-term economic development plan cycle for the city of Vallejo, and we looked a little bit at the shipbuilding piece, and our plan ended in late 2023. So we did not know the results of the 2024 election when we finalized, per se, but it'll be intriguing to see if there are some opportunities for the Mare Island shipyard to come back as a 2.0 structure around either military or commercial shipbuilding. We will see. I think net positive in terms of at least some momentum in that direction, which is great in that sense. I still am kind of scratching my head at the long-term economic value of that plan from the Trump administration standpoint. I think it's great if Vallejo is able to gain any marginal resources or in Solano County generally from such an executive order. We will see.
Okay. Let's see. So how do you see the work from home policies impacting the office market in the Bay Area
Um,
moving forward?
yeah, I think it will have some positive marginal effect, but it will not change the game in a quantum sense. I think there's still going to be a lot of resistance unless there's a real sea change in the way that workers are able to come back to work and have their lives supported when they come back to work. They're going to still want to work from home at least a couple days a week. So I think we're kind of getting to the point where we may be at the peak of the use of office. And if that's true, that'll lead to some real strange commercial real estate decisions that need to come in the next couple of years for the larger office spaces, specifically in the Bay Area, but throughout the country. I don't think we're going to go back to pre-pandemic utilization anytime soon.
Okay, let's see.
Vicky, I think we're at
Um,
time.
we are at time. I was just looking to see if there's anything else we might be able to answer quickly, but yeah, there others are a little bit more in depth. So yep, we are at time. I appreciate everybody spending your Monday morning with us. Look forward to another one. I'll talk with Rob. We'll look forward to doing another one a little bit later.
Thank you, folks.